Be honest with me. When you see how much of your paycheck goes to taxes, do you ever feel like you're just working harder than you ever have, but keeping less and less?
It almost feels like a game where the rules are stacked against you. No matter how much you earn, this guy named Uncle Sam always seems to take the biggest slice.
And here's the kicker. Most people don't actually understand how the tax system works. They think, oh no, I'm in the 24% tax bracket. So that means that 24% of all of my money is automatically gone. And that's totally wrong. That misunderstanding alone can cost people thousands every single year.
And the crazy part is, you actually have control over how much tax you pay, both today and in the future. But the problem is, no one ever teaches you how to do it.
So today, we're breaking it all down. We'll show you exactly how the progressive tax system really works, how to legally reduce your tax bill with retirement accounts, and how to set yourself up so you can keep more of what you earn over your entire lifetime.
So if you ever felt frustrated, confused, or just plain ripped off by taxes, well, this is the FI Guys community where we talk all about finance, philosophy, and a little bit of everything. You found your community to move yourself forward in regards to your money and your life. And in today's episode, we're going to change how you look at your finances in regards to taxes. And we're excited to take you on this journey. So with that being said, let's get right into it.
Welcome to episode 9 of the FI Crash Course Remastered. Tax optimization, keeping more of what you earn. In today's episode, we're going to unpack how the US tax system works and explore strategies to help you legally reduce your tax burden, keep more of the money you make, and build long-term wealth. But before we get into that, Dominic, what do you think about taxes?
Man, I hate taxes. Nobody likes taxes. Everybody hates taxes. If you have a friend that enjoys tax or likes taxes, look into him. Report him or something. That's not a real guy.
That's a narc.
Like that. Yeah, it doesn't exist. Total facade. No virtue signaling or something. Something weird's going on there. Nobody likes taxes. Everybody hates them. They're kind of illegal and down with the IRS is what I say. But until that happens, let's get in on all the information we can to save as much taxes as we can, because Lord knows that those roads aren't getting fixed and that military budget is only going up. So me personally, big shout out to the military, love the military, but I would like to keep more of my own money for myself. Not selfish, but kind of how I'm rolling these days. I'm excited though. I know there's a lot of different tax strategies that I've heard online, and maybe we can debunk a few and, give our praise to a few more. And I know you're about to drop some wonderful knowledge on us, Chris. So I'm excited. I'm super excited, and I'm just excited to learn today. So
of course, I'm looking forward to it too. And we're going to talk about all the legal strategies. There are some illegal strategies, but I always say, why go ahead and teach all the illegal strategies that no one can even do anyways? Or if you do it, you're just going to end up in jail. So let's talk about the things that you actually can do that our common people can just get done today if they want to. But before we get into that, I do want to start in segment 1, the purpose of taxes. And of course, this is according to our government and IRS.gov. And what they say is that taxes provide revenue for federal, state, and local governments to fund essential services, defense, highways, police, a justice system that benefits all citizens. So we have multiple types of taxes there: federal, state, local, and FICA. FICA means Social Security and Medicare, which one day we all hope that our generation will get. Most likely we won't, but we hope that we will get that. So I think we should have a quick discussion, Dominic, before we go any further on, do we think that taxings and the government services are always the best way to provide these services to our citizens? I'm just opening the debate. Let's go out there.
Let's just open the debate. Man. Yeah, open the floor right up. I'm a big supporter of private individuals taking things into their own hands. I know that sounds a lot like Batman. I know it sounds a lot, but in my mind, what I was thinking more of like, hey, the road on my street is broken. There's a little pothole in it. Let me just go put some, quick patch stuff in there. fix it myself because Lord knows the government ain't gonna fix it. Why? I don't know. No, but I think taxes are important, right? I know came out strong in the intro with down with taxes. Taxes are illegal. Give me liberty, give me death. Big shout out to the founding fathers, right? But they are necessary, right? I do love having roads and a justice system and police. We love them. Love all of them. I don't want to get too political, so I'm just going to stop right there. But no, I think taxes are an important part of society, and it's an important part for every citizen to really contribute to the country. I mean, outside of voting, there's not too many other options, right? You got voting, taxes, and jury duty, right? That's most of what your civic duty really is, right? And while I love this country, I would like a little bit less of my civic duty, right, to keep for myself, as everybody would. So, and I'm just kind of curious, Chris. Are you going to tell us the illegal ones so that we don't do them, perchance?
Maybe on FI Friday feedback. So maybe our
Okay.
rejoin us there to talk a little bit about it, but probably not, just because I don't want to lead anyone down a rabbit hole where they can say that Chris taught me how to do this on the FI Guys podcast, and I get in trouble for that. But I think that when we talk about taxes, we need to have a discussion as to like the libertarian view versus like the liberal view. The libertarian is everyone is for themselves, or there's the socialist view of like, this is a collective and we must all be taxed at the same rate. And, everyone just lives in kumbaya land. And I think whenever you try to go to either one of these extremes, they both sound crazy. Like one might sound a bit more, like one sounds really, really nice. One sounds really, really nice, but at extremes, they're crazy. What we try to find with our tax system is something of a middle way, something where there might be you might have your craziest libertarian uncle who says that like the government should stay out of everything. But the moment that his house starts to burn, he wants to be able to call a socialist system of fire department to come out and help you. Not a private citizen fire department who's, as your house is burning, trying to negotiate how much they're going to charge you to save your house. So taxes do offer a lot of benefits, including when someone breaks into your house, you want to be able to call the police. You don't want to have to call private Joe Schmo security who's going to say, yeah, I can be there in 45 minutes. If you want me there in 30 minutes, though, it's going to be an additional cost. We want to be able to have that system to be able to help us out. So again, there is a middle way. Whatever our listeners and myself, Dominic, and yours opinion on taxes are, I would much rather deal with the way that the system is than the way the system ought to be. So when we're talking today about taxes, we're going to be talking about what you can do to control it. Rather than just sitting here and complaining about it, let's take control of what we can and then deal with making the world a better place so that it's more to our likings in the future. But right now, this is the system we have, not the way that we want it to be.
And I think that's an important thing to note, right? Obviously, we all want a different system, right? But we have to play the cards that are dealt. And while these are the cards that we might not like, it's what we have. And we got to do our best with what we have. It's our duty, right? Nobody else is going to come along and kind of, hey, I'm going to do your taxes for you and I'll do it. I don't know. We're all adults here. It's important to take control and be knowledgeable about the happenings of society and how it works. So, I mean, clicking on this video is a great start. Let's get to the end and then we'll talk.
Perfect. So let's move on to segment 2, decoding the progressive income tax system. What I find from talking to so many people when it comes to taxes is that they have a fundamental misunderstanding of how taxes actually work. So what I mean by that is that the U.S. federal income tax uses something known as a progressive tax system. And what that means is that not all income is taxed at the same rate, despite what your crazy uncle might tell you. So first up, let's talk about what marginal versus effective tax rates are. Marginal tax rates means the rate applied to your highest dollar of income. Your effective tax rate is your actual average across all of the incomes. So let me try to put this into a better way for you. Let's just say that we have Joe Schmo Jane or Joe Schmo Joe who makes $100,000 a year. Well, if you make $100,000 a year, that's going to put you into the 24% tax bracket, maybe the 22%, depending on what deductions you want to take. Let's just say it takes you into the 24% tax bracket. What most people think is, man, I made $100,000. That means that $24,000 automatically is taken from me and goes to taxes. Now, if I was smart, what I would have done is made $98,000 and been at the 22% tax bracket, meaning that only 22% of the entirety would have gone to taxes. So I have met people who decide, I don't want to make more money because if I make more money, it's going to send more money to the government. And again, that is not the way the system works. We have a progressive tax system. So I know that a podcast isn't the best way to do this. So I would recommend that you go and you Google or you chat GPT, show me the 2025 federal tax brackets for a single filer or a married filer and actually look at that. But for a single filer in 2025, your first basically $12,000, it's really $11,925, but I'm just going to round it up for sake of the podcast, is taxed at 10%. Your next $12,000 to about $48,000, $49,000 is taxed at 12%. From $49,000 to $100,000, 22%, 100 to 200, 24%, 200 to 250, 32%. So this goes on and continues on up to the 37% tax bracket. What this means though, is that if you look at somebody and they made $200,000 a year, that would put them into the 32% tax bracket. But that does not mean that all of their taxes, all of their money is taxed at 32%. It means the first 10,000 was taxed at 10, the next little bit to 50,000 was taxed at 12, so on and so forth. And that makes up your effective tax rate. What is the average of the taxes that you're paying in each one of these buckets? And buckets is a good way to think about it. I want you to think about if there was a bunch of buckets sitting in front of you, some smaller, some bigger. And every time that you fill up that bucket, each one of those has a little hole inside of it. If you went to the biggest bucket, you poured everything into that, you can't just fill up the biggest bucket until you fill up the other buckets. So an example might be that a single filer who's making $110,000 a year falls into the 24% marginal tax bracket. And what that means is that their highest taxes is getting charged at 24%, but their effective tax rate might be closer to somewhere like 18%. After deductions and credits, their real tax burden is substantially lower than the bracket headline number would suggest it to be. Dominic, what do you think?
You know, I don't think most people know that. I think a lot of people, I mean, I don't know if this is true or not, but the common running like joke is, I don't want to get that raise because then I'm going to actually be making less money because, well, once I cross that threshold, they're going to take even more. It's just not worth it. That might be a common kind of thing that you hear in the workplace, but yeah, most people don't realize that it's a progressive system. And I think thank goodness that it is, right? It's actually more beneficial for us and it makes more sense, right? So, I mean, let us know. Did you guys know that the system is a progressive system like that? And if you have any questions, leave them in the comments. We'd be happy to answer them. But yeah, it's kind of interesting. I mean, I love the bucket analogy, right? That the first bucket is taxed at this percentage. And then once it's filled up, well, then the rest of the water drips down into the next bucket. That might be the higher tax bracket, right? And it just keeps going up and up. And I think that's what's kind of confusing on taxes, right? Where it's like, oh, I made 100,000 this year. I must be taxed at this much. Well, why didn't I pay that much? Am I committing a crime? I didn't wait and listen to FI Friday feedback where they talked about the crimes of tax. We're going to get there. So are you. And if you're not going to get there, that's bad. Make sure to like the video and subscribe while you're here. That being said, let's get back into taxes. So I'm curious though, what can we really do to offset these taxes, Chris? I know you have strategies. What do you have for us?
Yeah, well, let's get into that. But the biggest thing that I want people to take away from segment 2 is that most people will look at their marginal tax bracket, which is their highest amount that they will be taxed at for whatever that amount is into that tax bracket. And they will believe that that is their entire taxes. So remember, effective tax rate is what you're actually taxed. Marginal tax rate is what your highest amount is going to be. And then again, we have a progressive income system. Progressive in that it continues to level up. So let's talk a little bit about some of the ways we can reduce our taxes. And the first one I want to talk about is that we already have standard deductions. And what standard deductions means is that the federal government says, hey, you as an individual automatically we're going to take some money and say that you magically did not earn that money. You get to keep that money tax-free. So in this 2025, single filers get an automatic $15,000 deduction. If you're married, filing jointly, meaning you and your spouse, it's $30,000. And while you might think, oh, wow, so if I am married, that means that I get more taxes or I get less taxes. It's not really true. If you double 15 by 2, it's 30,000. All you're doing is filing one tax system for 2 people. All that does is double the money. But if you're the head of household, meaning that you have dependents on you or you have a spouse and you're the only one filing, then it goes down actually to 22,500, which is typically not the best way to go about it. So that's something that we need to think about, that we already have some systems in it, meaning that if you made $100,000 this year, automatically, you don't have to do anything for this. And say you're a single filer, you get to tell the government, hey, I only made $85,000 because you get that automatic standard deduction. So $15,000 is already yours, tax and penalty free. So there's already something that's already there. And the hard thing about taxes is most people have no idea what they're doing. So they just look at that final bill and they decide to fight it or scream or argue with it rather than understanding what it means. And that's what this podcast is all about, to understand why you are paying what you're paying. So I want to go on into ways to actually reduce your taxes. Before we do that, I need to talk about the paradox of wanting to earn more while also trying to pay less taxes. Just like you said there, Dominic, earlier. And I've talked to people who say, oh, I don't want to make more money because I'm going to have to do more. I actually have to take a few months off of my business because if I make more money, it's going to push me into the next tax system and then I'm going to lose money on it, which, again, listen to segment 2, is not the way the system works and is not the way it has worked. It's just people don't know what they're talking about and they tell you their misunderstanding as if it is fact. So in general, during your peak earning years, that is when tax planning matters most. And it matters the most because when you're in those peak earning years, you have a higher marginal tax bracket. And if you have a higher marginal tax bracket, that means your effective tax rate is most likely higher. So we have some strategies to reduce our taxes legally. And it helps us to plan for our retirement, to get us closer to financial independence faster. And that's by using both traditional, which is pre-tax, and Roth, post-tax accounts. We can leverage deductions, credits, and tax advantages. And by planning ahead for potential future tax increases, by diversifying where we hold our wealth, it gives us the optionality and the flexibility to move with whatever way the winds take us in the future. Because anyone that sits there and tells you, I know exactly what the tax bracket is going to be in 2065 is lying to you. They have no idea. No one knows what the future holds. So what we recommend here at the FI Guys is try to have as much optionality, because it could be that in 2065, our tax rate's at 0% because America blew itself up, or it could be at 100%. We have no idea. So let's try to have that optionality to be able to figure it out when we do get there. And if we blow ourselves up, we have bigger problems than our taxes, but just a way to think about it.
Yeah. And one of the things that I think that I'm kind of getting at, the underlying, is that taxes aren't something that we should be worrying about. Right, Chris? Like, there's better things to worry about, like what to have for dinner or, what to get your spouse for Christmas or something like that. Right? Taxes should be an afterthought. We should learn about it now, take care of it now, so that down the line, we don't have to worry about it. That's kind of like what you're getting at, right, Chris?
Yeah, I would agree with that. There's an old saying in financial planning. It's don't let the tax tail wag the dog. And I know that doesn't really make a lot of sense, but basically what they're saying is don't get so hung up on taxes that you're making suboptimal decisions for your life and for your finances. For example, I don't want to pay more money into taxes. So I'm going to make less money so that I don't have to pay as much. So I'm going to destroy my lifestyle so that I can pay less in taxes. Or there's this investment that gets me a tax deduction and it's going to lose me 50% of my income. But at least I get the tax deduction. And when you look at the net negative at the end of it, it's like you lost yourself $3,000 a month by doing this crazy tax loophole, but at least you saved $400 on your taxes. And that's the way that most people go through life, trying to figure these things out. So let's talk about some ways you control your taxes through retirement and investment accounts. because it's one of the best ways to manage your tax bill through these tax advantage accounts. These tax advantage accounts not only help you save for your future, but they also reduce how much money is exposed to your taxes today. So it's not just saving you money in the future, it's saving you money today, and most people don't know about it. So this is the real meat and potatoes of this podcast. We're going to talk about the different types of retirement accounts in plain English. Because I think when people hear 457, 403B, traditional versus Roth versus HSA versus catch-up contributions, they're just like, I don't know what the hell you just said to me, but I'm going to take it as disrespect. So I'm going to tell you to watch your mouth.
That's pretty good. That's pretty good.
I want to teach you what it actually means. So when some finance bro comes up to you and starts talking to you in finance language, you can sit there and call them on their BS because most likely they don't know what they're talking about. So the first thing I want to talk about is our workplace plans. This includes our traditional 401k, our 403b, our 457, and maybe even a TSP. And if you don't know what those means, then you probably don't have that for your organization. Or if you do, talk to your HR representative. They're there to help you. Or ask ChatGPT if you are afraid to ask a human being. So with these traditional accounts, for the 401k that are workplace, you put in money before taxes are taken out, lowering your taxable income now. The money grows tax deferred, and you pay taxes when you take money out in retirement, traditionally after the age of 59 and a half. And that number may move or come sooner in the future. We don't know. But at this time, it's 59 and a half. So what that means is that any money that you put in today, so you made $100,000, if you want to put in $20,000 into your 401k traditional, that means that you're telling Uncle Sam, hey, I only made $80,000. And remember, you also get the standard deduction, taking that down to $65,000 that you get to tell Uncle Sam, I only made $65,000. That helps you not only have money for your retirement that now gets to compound for you to be money in the future, but it also reduces your taxable burden by hundreds to thousands of dollars this year. So it's not like, oh, in 30 years, it's finally going to benefit me. No, it benefits you right freaking now, and it benefits you in the future. And the messed up part is those are both the same exact person.
Interesting. I think that's really interesting. So the more you invest in the accounts we were talking about just now, like the Roth IRA and the traditional IRA.
We're talking about traditionals there.
Traditional. Okay. The less, so say I put $1,000 in, that on my taxes showed that my taxable income was reduced by 1,000. Therefore, I don't have to pay taxes on that 1,000 because I'm investing it in the future.
Yep, exactly. And there's a way to do that. So if you're just like, oh, it's okay, I know how to file taxes, you probably don't. It's called a tax deduction, meaning that you're still going to tell the government, hey, I still made $100,000. And then later on, when you're doing your taxes, you put, and I put this much into traditional accounts, like $7,000. So I want to deduct the $7,000. You don't just magically do what you want to do and like not report stuff. You have to report it the right way. That's where a CPA comes in. That's where a tax professional helps you out so that you don't screw it up. Because the amount of people that I have talked to who screw this up because Uncle Jim Bob told me that I can do this if I do this other thing backwards. And if you put money in my account, then I put money in your account. And then we all do a dance and sing along. We don't have to pay taxes. And that works until the IRS finds you. And then it does not work. So let's move on to traditional IRAs. A traditional IRA works a lot like your 401k, like your 403b, like your 457, just like those workplace plans, but it's the personal version. So when you contribute to that traditional IRA, you get to make contributions that are tax deductible. And of course, these ones are actually subject to income limits where the workplace ones are not. And what that means is that you pay taxes when you withdraw the money. So that's when people would say, oh, you don't want to use traditionals because taxes are going to be higher in the future. That's most likely true. And in the future, when you are retired, you will not be producing an income like you currently are in your highest earning years. That's the balance. That's the yin and yang. That's why no one can tell you exactly that this is what you must do, because no one knows what the future holds, not only for the government, but also for you as an individual. Far more of personal finance is personal than it is finance. But with these traditional accounts, we can reduce our taxable burden today and save money in the future. And yes, in the future, you'll have to pay the taxes then and allow yourself to make that decision when you get there. It gives you some more optionality. Before we move on to Roths, Dominic, do you have any other questions?
No, I think that's an interesting thing you went over just now about when you retire, your taxable income will most likely go down because you're not working anymore. So you're going to be in a lower tax bracket. So it'll benefit you in that scenario, right? But I know also there's some people who they make more money or they make the same or a little bit below or a little bit more in retirement based on how they set up their life, right? So I guess it's all about planning. And I don't know, it can be fun. I think you're making it fun. You're making it less stressful. And I think that's something that most people need. Right? I think everybody needs that, right? Because taxes, I don't know why the tax code is so insane. I don't know why it's so long. Like, is it a book, Chris? Is it like a PDF we can download? Is it on like a note card? Like, how big is it?
It's huge. It's a PDF. You can download it right now, and it is thousands and thousands of pages. And basically, what it is every single person has put their hand in the pot over years and years and years and generations of everyone trying to get a little bit of their own. We could simplify it. I think we should simplify it to like a single tax system of like one rate. Like everyone's taxed at 20%. Doesn't matter if you make $10 or $100,000. We're all taxed at the same rate. A fixed rate would probably make it a lot easier. Or if we did a progressive tax system without deductions, or like you just get the standard deduction, nothing else, we could really simplify this. But unfortunately, there are a lot of lobbyist groups that don't want that to happen. They want it to be as complex as it possibly can, because that's how they make more money, by our negligence, our misunderstanding. And that's the reason that we're trying to talk about this today. Not that you can go there and be a tax expert, but so when you file your taxes, you actually understand what the hell is going on, rather than just giving a bunch of magical paperwork to your accountant or into TurboTax, and then it spits out that you owe $2,000 or that you got $2,000 back. And now you feel good that, oh yeah, I paid more money to the government at a tax-free loan for longer. So now I'm getting money back because I'm so smart. That's not what that means. It's the exact opposite, in fact. So let's move on to Roth IRAs and Roth 401ks. Roths are one of the big ones now. People always say, oh, if you're young, you have to use a Roth 100%. If you don't, you're stupid. And that's not necessarily true. It could be true depending on your situation. But the way that Roths work is you contribute after tax money, but it grows tax free. So when you withdraw in your retirement account, you don't have to report that to the government. It's a great way to protect against higher future taxes. And that also means that today you're paying those taxes. So again, if we either have that person that makes $100,000 and they want to put $20,000 into their Roth 401k, you can do that. And in the future, when you take that money out, you don't have to report anything. And that's great. And that also means that today, when you go to file your taxes, you don't get to say, hey, I put $20,000 into my Roth, so I don't want to have to pay that. You're paying that today. And if you're making a lot of money, if you're, say, you're someone who's really rich and you're into those higher tax brackets, that could be a pretty big hindrance. That could be like you could be in the 30% tax bracket if you really look at that. Now, there are ways to think about these when it comes to income limits, and we'll talk about those here in a second. But the Roth is a wonderful tool, and that's all it is. It's a tool. It's not the end all be all. The amount of times I talk to people and I say, hey, do you have investments or what do you have? And they go, I have Roth. And I go, Roth what? A 401k, an IRA? What do you mean? The Roth. I have traditional. That tells me that they have no idea what's going on. And that's what, when you listen to this and you hear what we're saying and you actually apply it to your life, you can realize that most people who are talking about finance have zero idea what the hell they're doing.
So it's kind of funny that you said that, a lot of people in finance don't know what they're talking about. One time, this is when I was much younger, I had a question. My dad had opened up a Roth IRA for me, a custodial Roth IRA, which means that he sponsored it because I wasn't of age yet. I think I was in high school, and because I was really into stocks, right, as all young boys are. And I was really into stocks. I was like, man, and I got this software called Thinkorswim, right, and it was like a really high level software. And I had some questions on it, and I called up, I think it was TD Ameritrade at the time.
Ameritrade at the time.
Yeah. And they don't exist anymore. They got bought out.
With Schwab.
Yeah, now they're Schwab. And I was asking questions, and during the conversation, the guy, he basically just blurted out the fact, he's like, yeah, Roth IRA. He's like, that's for poor people. I was like, what? He's like, yeah, that's for poor people. I wouldn't use that. Like, okay. And as random as it as I just said it, is as random as I heard it. And I was like, that doesn't sound accurate. I was like, where'd you get your degree from? I didn't, hangs up the phone. And no, but there's a purpose for all of these tools, right? And a Roth IRA, there's a great purpose for it, right? And we just talked about it, right? And could we do like a little recap over the Roth real quick?
Yeah, of course. So for the Roth, your contributions are made after taxes. So it means you're still going to pay taxes this year. But that means that the growth that happens in that account, the entire time that is growing, you're not paying taxes on it. And when you take the money out, you don't have to pay taxes on it. You don't have to tell Uncle Sam anything about it. You get to keep that. And the thing we know about compound interest means that that's not getting taxed the entire way through. So that $100,000, if we use the rule of 72, we apply a 10% growth. If we do a standard index fund, like an S&P 500, that means that $1,000 in 7 years will become $2,000. The next 7 years, $4,000. The next 7 years, $8,000, so on and so forth. And in the future, when you take that money out, none of it's taxed because you pay tax at the beginning. But that means that you have to pay taxes today in order to do that. Versus the traditional, that is the exact opposite. The Roth and the traditional are the same thing, just inversed. When do you want to pay taxes, now or in the future? Let's discuss a little bit about the HSA, the health savings account. This is an account that is one of my favorite accounts when it comes to tax advantages. And the reason for that is it's actually triple tax advantage, meaning that contributions that you put into it are tax deductible in this year. The money grows tax-free, just like the traditional and the Roth. And this is the craziest part. When you withdraw the money for medical expenses, it is tax-free. That's why it's called a health savings account. So that means that the money went into it, tax-free. The money that it grew, or when it grew and it was invested, tax-free. If you take it out for medical expenses, tax-free. And then after the age of 65, you can turn it into a traditional IRA, given that you don't have medical expenses. But if there's one thing we know about this country, it's that you will have medical expenses when you reach 65. You probably already have medical expenses right now, and you can use that HSA to spend money in that account and to get those tax deductions. And there's a better way to do that. Currently in the IRS, and this is one of those secret thingies that we said we talk about, it's not illegal. There is no limit as to when you can give a receipt to claim your deduction or to claim getting your money out, meaning that you could put money in right now, 2025, put $1,000 into your account and let that compound for the next 30, 40 years. And then at the end of that, when that's $10,000, $20,000, $30,000, you can go and say, hey, back in 2025, I went to the doctor and I had this $50 deductible thing that I had to pay, and I paid it with my credit card. And here's the receipt. So I want to take that $50,000 out of the $30,000 that it's grown to, rather than the $30,000 rather than the $1,000 that I put in. So that's just one high level way that you can use these things. Additionally, if you want to talk about other ways to save on taxes, there are things called Roth conversions, where you can put your money into a traditional account, get the tax deduction, and then in a year that maybe you have a kid and you have to take some time off of work, maybe in a year that you get sick, or maybe in a year that you know, hey, I'm going to take a mini retirement and I'm not going to work for that year, well, you can do a Roth conversion. And you can convert that money from traditional to a Roth in a year that you're not earning a lot of money and get taxed at a lower tax bracket. And sometimes, and again, this is a higher level thing that you'd have to contact Chris at Monzon Wealth in order to get, not pay any taxes at all at certain amounts. Now, I want to talk a little bit about catch-up contributions. So people over the age of 50 get to have additional amount of money to contribute to their retirement accounts. And people between the ages of 60 and 63 have something called the super catch-up for workplace plans. These are all awesome. And the reason that we have these catch-up contributions is because the 401k, the traditional IRA, and the Roth are all so new. The 401k only started back in the 80s. And in fact, it was part of the tax code. It was part of I think it was like tax code 401k. And that's the reason that it's called the 401k, because of that. Like, it's not that old of a thing. The Roth IRA is named after a senator, like Senator something Roth from some state back in the 90s. Like, these aren't that old. So when people say they know how things work because they have so much extensive history, they have like 30 years of history on how it works. And that's why we're all confused about it, because this isn't some generational knowledge that we all have. We're all figuring out as it goes. And that's why having the optionality and the flexibility when it comes to tax planning is the way to go, in my opinion, and what we kind of espouse here on the FI Guys. Control what you can control and leave everything else to be. Dominic, before we get to IRA contribution limits, what do you have?
I think that's interesting. I didn't know that they were this new. I didn't know that they were only like 30, 40 years old. I guess that's a cool plug for whatever Senator Roth. Part of me is like, Senator Rothschild? It's like, no, that's not a thing. But that's really interesting. I didn't know that. And quick question on the HSA, the health savings account, spending that on medical, right? What are we talking here? Are we talking like the dentist? Are we talking like a copay that's out of pocket? Stuff like that, right?
So it's a very wide ranging amount of things. You could even use it for things like Band-Aids. Sometimes there are things like a whoop strap will be eligible for for an HSA contribution. The big thing when it comes to that is you can go to the IRS.gov and you can look up everything that qualifies for an HSA expense. And I will tell you, there is a lot. You can even go to ChatGPT and ask, and then make sure by actually checking on the thing. But there's 1,000 different things. One thing about the HSA that I didn't mention is in order to qualify for an HSA, you must be on a high deductible health plan. And that could be through your work or through your own self. But you just can't go and open an HSA if you have a PPO or an HMO. If you don't know what that means, we will get to that when we talk about insurance here in the FI Crash Course in the next few episodes. Now, I want to talk about 2025 contribution limits. And these contributions are going to change every single year. So if you're watching this podcast in 2027, 2028, the contributions will change. And that's okay. That just means that we're making progress. So for this year, 2025, 401ks, any workplace plan, 557 or 457, 403b, TSB, $23,500 per year. You can put that much money into a traditional account, lowering your taxable burden by that much. If you're over the age of 50, you get an additional $7,500. That means you can save over $30,000 tax-free. If you're between the ages of 60 and 30, or 60 and 30 or 63, you get an additional, or it actually goes up from 7,500 to 11,252. So if you're within those ages, 60 to 63, you can basically save $35,000 into your workplace plan, into a traditional account, and just save that money. Now there's with the IRAs, it's $7,000 and then $8,000 if you're 50% or 50 or older. And then with our HSAs, individuals in 2025 can save $4,300. Families can do $8,550. And then if you're over 55, there's a catch up of $1,000. And there are phase outs for these. And phase outs means that people that are earning very high incomes can't also do this. There are ways around it, like a backdoor Roth, which again, we can teach here at the FI Crash Course, but or in the FI Guys in a different episode, but that's not the point. So for traditional IRA deductions, if you're covered for a workplace plan and you're single, making between $79,000 and $89,000, making above that, then you cannot get a deduction for your traditional IRA. If you're covered by a workplace plan and you make over a certain amount. And then if you're married, it doubles that amount. It goes to 126 and 146. And then for Roth contributions, if you're a single person making between 160 or over 165, you can't contribute to a Roth at all, unless you do a backdoor Roth, which is a fun little loophole that's available to you at any time. And if you don't know what that means, eventually we will teach you how to do that, or reach out to me, chris@monzonwealth.com, and we can talk to you about how to do that. But I want to give you a quick example just to make this a little bit easier, because I know talking all of these numbers on a podcast doesn't work very well. So say that you're a single earner, you're earning $100,000 a year. If you want to, you can contribute $23,500 to your work's 401k and reduce your taxable income. That means that your work has to have a traditional 401k, which they do. Some workplaces have Roth 401ks, but let's just say that you did the traditional. And then you wanted to also max out your HSA, your health savings account, with $4,300. That means that you have lowered your taxes, or your taxable amount that you have to report to Uncle Sam, by $27,800, dropping your effective tax rate down dramatically and saving you thousands of dollars now, while letting you save money for your retirement and your healthcare in the future.
Interesting. I hope everyone's taking notes, because there's a lot of numbers being thrown around here. A lot of numbers. So I'm curious. This is going to be very overwhelming for a lot of people, I believe, right? And like you
Probably.
said, they kind of want us to stay confused so that they have more control over us. But if someone was like, okay, I just want a rudimentary knowledge of this and how it works, but I want like a professional to like help me with it, kind of what direction would they go in, Chris? Like, would it be an accountant? Would it be like a financial planner? Would it be a tax? Is there a guy that they can kind of go to?
Not not that I would feel comfortable sending people to unless it's like a financial coach, like something like I do.
Yeah.
Because what I do, it's what maybe what you would want to look for is someone who is a fee only financial advisor or financial planner to be able to explain it to you and get you to walk through it. But the best thing to do would probably just be start to learn on your own. Like just start down the path of reading articles, talk to ChatGPT, check ChatGPT to make sure that it's right. Cause oftentimes when it comes to taxes, it is very wrong. But like it's just learning a little bit. Like guys, like to everyone who listens, like if you have listened back to my story of like where I come from and like my background and the kind of student I was, everyone thought I was going to fail. Like everyone thought that I was stupid, and I figured these things out. And now that's the reason I've come back to try to teach people how to do these things so that they don't have to go through the same stuff I did. It's not as hard as you think it is, but every time that you stand at the foot of a mountain and you look up, you're like, there's no way in hell I can get up to that mountain. That is at the top. All you have to do is start one foot in front of the other and learn a little bit every day. That's the aggregation of marginal gains. That's what we talk about every time on this podcast about getting 1% better. I'm not asking you to go from where you are right now to being some CPA wizard. I'm asking you to get a little bit better today. And just by listening to this podcast, you are already on the path. You might now understand, hey, we have a progressive tax system. I didn't know that. I can actually make more money without worrying about it. And if I want to, I could put money into a IRA or a 401k at work and then show the government that I only made the same amount before I made this great income increase, which makes my life better today and makes my life better in the future and lets me keep more of what I want. How cool is all of that? And that all comes with knowledge by putting yourself into the fire, into the arena and learning a little bit every single day. And then when you look back on your journey, you get to see how far up the mountain you came. But it takes one step. It all starts with one step. And then each day you get to make a decision. Do I want to take another step or do I want to sit where I am? Because too many people are complacent, sitting down at the base of that canyon and never even trying. Dominic, before we finish off with segment 5, do you have anything else that you want to talk about?
No, I think it's a lot to process. I think it's a lot to process. This might be one of those episodes where you take the URL of it on YouTube and throw it into one of those AI ChatGPTs that's like, hey, summarize this for me, put it in a PDF spreadsheet, and just file it away for your tax season as a nice little cheat sheet. But no, I don't think there's anything that I'm really questioning. It's more of just like making sure that it soaks in, making sure that it processes in. And
it's difficult. You might have to listen to it a few times. And also remember that like we aren't the God's truth. Like we aren't the logos. We aren't perfect. There are many times that I'm going to trip up on this podcast. Dominic's going to trip on this podcast. We'll say wrong numbers. We do this live. So you can't even take what we say as truth, but take what we say and then it should spark an idea in you to go and try to find more. We do the best that we possibly can to be good and to give you the best advice, but we are going to mess up. And that's okay. That's part of being a human being. That's part of putting yourself out there to try to help other people. Now, I want to move on to exceptions and considerations for our listeners who may do what you said, Dominic, and try to file this away for later.
Mhm.
So one of the big things that people don't understand is filing status. And filing status could be single, married filing jointly, married filing separately, head of household. And these decisions can significantly impact your tax planning. So you need to be able to understand these things. And if you don't know what it means, Google it. If you don't want to Google it, ChatGPT it. If you don't want to do that, Claude it. I don't care. There are some states that are called community property states. Those states are things like Arizona, California, and Texas. Former countries or former states that were once part of Mexico are community property state. And then I think like Delaware or some random place. But they treat income as earned or income earned during a marriage as equally shared. Meaning that in some states, you can say, like in Oregon, you can say, hey, I want to do married filing separately. And I, as the husband, make $100,000. My wife makes $200,000 and we can file separately. And then I can say I made 100, my wife made 200. But if you're in one of those states that are community property, it's going to get split 150 each. They're going to take all the amount. Doesn't matter if you want to do married filing separately or jointly or whatever. It's going to community property that, and then whatever it is, they're going to add it up and divide by 2. And that's how much you made as an individual, even if you didn't actually make it on your 1099s, on your tax return numbers. And then we have to consider future income. If you expect a large pension or high retirement income, then a Roth account may be a better option. But if you expect lower income in the future, like many of us do, then a traditional contribution might save you money today, and you might be able to get that money out in the future for little to almost no taxes. And that's the big thing, is that this is personal. No one can tell you, oh, traditional, that's so stupid. Why would you do that? Roth, that's so stupid. Why would you do that? Neither, that's so stupid. Why would you do that? Each one of these is a tool, and each one of these tools works somewhere. If I'm trying to screw in a light bulb, or if I'm trying to fix my door handle, I know that I need 2 screwdrivers and it's going to be able to get everything out. But if someone gives me a hammer, I'm going to be like, this is a stupid tool for this. Or they give me a chainsaw, this is a stupid tool for this. Just because the tool is stupid for this one regard, it doesn't mean that it's a stupid tool in general. You have to know when to apply the tools, just like Batman in his utility belt. If he's fighting, I don't know, Killer Croc, and Killer Croc's coming at him, and he decides to get out a belt, I don't even know what he would have, like some random thing, like that's not going to help. You have to take out the right thing that's going to work for you. So the bottom line is that no one knows where taxes will go. We all have inclinations, myself included. I think they're going to be higher in the future. And today, I will challenge you to do a blended approach because it offers far more flexibility, not only today, but in the future too. And there are always things like Roth conversion strategies that are available to us at any time. And we will cover that in a future episode if that's something that we want. But our key takeaways is that understanding the tax system and using retirement accounts wisely can help you control your effective tax rate and keep more of what you earn. The right strategy depends on your income, your filing status, your long-term financial goals, and what you believe the future will hold for you and for the country. And no one knows what that's going to be. Before we get to our action step, Dominic, do you have anything before we close it out?
God bless the tax code. God bless America. Good luck in your tax journey. My gosh. It's chaos out here, man. It's chaos. But I think things got a little bit more simple today. But if you let them get complicated, they can also be complicated, right? Things can be simple if we just stick to the simple stuff. There's like 30,000 pages. Let's just focus on the pages we need, right? So,
and it's the same thing when it comes to finding, like, once you see the way broadly, you see it on all things.
yes.
If you want to make your health journey the hardest thing in the world, where you're cold plunging, and then, I have this perfect, red light therapy blanket and all this stuff, like that all works. Or you can get 80-90% of the way there by exercising, eating right, sleeping right, and try to reduce your stress. Same with finance. We can talk about alphas and betas, and I do option trading, all this stuff. Or you can focus on making more money, spending less money, and then investing the difference into a broad market index. You can make this as complicated or as hard as you want, but getting 80-90% of the way there is done with the simple stuff. The hard stuff we can add on as sprinkles, but it's not going to make most of the difference to anybody. If you're an elite level athlete, elite level, top of your game, doing cold light therapy, infrared, all that stuff, that's going to ink out an additional maybe percentage point, maybe even point of a percentage point. But if you're Joe Schmo sitting on your couch saying, like, I really need to get fit, and you're starting at 0, it doesn't matter how great your red light therapy or sauna is, it's not going to help you because you're not getting 80-90% of the way there. So let's move on to our action step of the week. Before the end of the week, I want you to log on to your company's payroll or retirement account and check how much you're contributing to your 401k, to your HSA, to your 403b, your TSP, your 457. And I want you to ask yourself 2 questions. Number 1, am I contributing enough to get the employer match if it's available to me? And number 2, can I increase my contributions by even 1% without noticing it in my day-to-day budget? And if you're the person listening saying, well, Chris, it's really nice for people that have workplace retirement plans to be able to do this, then go into your IRA and create that. If you're saying, I don't have an IRA, then you should have been listening to the FI Crash Course a few episodes ago when we told you to freaking make one. You have the ability now to increase it to 1%, 1% to 2%, 2% to 3%. I don't care. I'm looking for 1% better. Because these small adjustments, these small money moves that we make today that are so simple, compound into thousands or even hundreds of thousands of dollars over time. And it lowers your tax bill now. Dominic, can you please close this out for FI Friday and then let the people know about FI Friday feedback?
Absolutely, guys. Well, if you got anything out of that, which if your ears were open and your brain is working, you should have, right? Tell us about what your favorite part was down in the comments. We'd love to hear it. Was it the health savings? Was it the fact that now you can possibly write off those medicines in your health savings account? Make sure to look it up. Make sure it's the right ones. Make sure it's actually covered. Was it the 401k stuff? Was it the Roth stuff? Was it the IRA stuff? Was it the secret tax stuff? Let us know what your favorite part was down in the comments down below, whether you're on YouTube or you're on Spotify or you're on any other platform that does allow the comments. Since you're still with us, feel free to give us a like. And if you're not already following the channel, feel free to follow the channel. We'd love to have you here back again, especially for Friday's episode, where we're going to learn about all the illegal ways to save money on taxes and why you shouldn't do that because breaking the law is not good. That being said, not promoting breaking the law. Be a good citizen. Just common sense, guys. But yeah, guys, if you enjoyed today's episode, make sure to like, subscribe, all that fun stuff, and make sure to share the podcast with a friend because it's always more fun to go on this journey, this legal journey with a friend. Yes, no Bonnie and Clydes in this episode or the next one. Don't break the law. That's not sarcasm. It might sound like it, but be a good citizen, follow the laws. Jail is not fun. Even if you see those cushy financial prisons, they're still not fun. Right, Chris?
I don't know. I've never been to one, but I like
a good answer.
I think my freedom's cooler.
That's a good answer. With that being said, guys, we'll see you back here on Friday for a very fun episode on taxes with a mailbag and a win of the week. Hope to see you there. I'm Dom. He's Chris. See you in the next one.
Later.
Peace.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the hosts and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.